In this session, we will be introducing standard costing. So we're busy with Learning Unit 6, Standard Costing and Variance Analysis, and you can refer to chapters 17 and 18 in the Drury textbook. So there's various learning outcomes in this learning unit, split into a few themes. So the first theme is variance analysis. We will be spending most of our time on theme 1, variance analysis. Theme 2 is the reconciliation of budgeted and actual profit. Then we move on to theme 3, recording standard costs in the accounts. And lastly, we will look at the investigation of variances. So this is on a level 3 for the SoFA competency framework. So it's a very important learning unit. You can expect not only calculations, but quite a bit of discussion as well in this learning unit. So in this learning unit, it's very important that you familiarize yourselves with the discussion or with the theory rather in Drury, because the investigation and the discussion will be based on that theory. So it's very important that you study that. And more importantly, you cannot just dump theory in your answer or in your script. You have to apply it. If you don't apply it, you will unfortunately not earn any marks. The standard costing is basically budgeting on steroids. So we're going to look at various line items in the management accounts, and each of those will be split into various variances. So we will be dealing with sales variances, with material variances, labor variances, and then overheads. So these are the most important variances that we will be dealing with. So underneath each of those, obviously it's broken down into a lot more variances. It is important that you refer to last year's workbook, since this is based on assumed knowledge from last year. Also good that you have a good understanding of budgeting. So with standard costing, it's about control. So we want to see what is controlled by the company, what is within their control, what is not within their control, and most importantly, who is actually responsible for the variances arising. So in the standard cost accounts, we record various variances, and we cannot keep everybody responsible for every variance. So for example, a production manager can't be responsible for a price variance, as can a financial manager not be held responsible for labor efficiency. So we look at various variances, and then who's responsible for that variance, what is the reason that variance arose, and then what can we do with it, and what does it mean if it's favorable or if it's adverse. In the next session, we will be moving on to material variances. So that's the first set of variances that we will be dealing with.